You've probably heard the words investing and trading thrown around a lot, right? They might sound kind of the same, but trust me, they are worlds apart. So let's get right into it and figure out what really sets them apart.
Okay, so when you think trader, what comes to mind? For me, it's that classic movie scene, right? Someone with their sleeves rolled up, yelling into a phone, just pure chaos. And then you have the investor. Maybe you picture someone like a wise old guru, calmly thinking about decades from now. And you know what? These stereotypes, while a bit over the top, actually do a pretty good job of pointing us to the core differences.
You can already see these are two totally different mindsets. And that brings up a really important question. Which one are you? Or maybe a little of both. Let's find out.
All right, to really get to the bottom of this, we're going to need a simple way to compare them, an apples to apples look. So let's break it all down.
And we can do that by looking at just 3 key things. First, their time frame. Second, their activity, what they actually do. And third, how they handle risk management. Seriously, once you get these 3 pillars, everything else just clicks into place.
So let's kick things off by diving right into the trader's playbook. We'll see how they handle those 3 pillars: time, activity, and risk.
Okay, so for a trader, time is everything. The clock is always ticking. It's all about the short term. Think days, hours, sometimes even minutes. They're not looking to fall in love with a company and hold it forever. Nope. The strategy is simple. Get in, get out with a profit, and then, you guessed it, do it all over again, looking for that next quick win.
But how in the world do they know when to jump in and out so fast? Well, that brings us to their main tool, something called technical analysis. Basically, they're not reading company reports. They are glued to price charts, looking for patterns and signals in the stock's movement that tell them, okay, now's the time to buy, or time to sell.
And what about risk? Well, for a trader, risk is super defined for every single trade. It's not just a vague hope. Before they even click buy, they've already decided their exit point if things go south. They use things like stop orders to automatically sell if the price drops to a certain level. It's all about knowing exactly how much you stand to lose from the get-go.
All right, so that's the trader. Now let's flip the coin and look at the investor's long game. We'll use that same exact framework: time, activity, and risk. You'll see just how different it is.
You see, for an investor, time isn't the enemy, it's their best friend. We're not talking days or weeks here. We're talking years, even decades. They're in it for the long haul, aiming for that steady growth. Plus, they often look for dividends, which are like little cash payments along the way. Some investors buy a great stock and literally have no intention of ever selling it.
So what are they doing all this time? Well, it's a totally different ballgame. Forget the charts. Investors are like detectives, digging into the health of the company itself. They're poring over earnings reports, balance sheets, the whole 9 yards. Why? Because they're not just buying a stock ticker. They're buying a piece of an actual business they believe in. And that completely changes how they think about risk. For an investor, the main way to manage risk is to do your homework and pick a solid company from the start. If the stock price takes a hit, they don't panic. They see it as just a bump in the road because they have faith that a good business will eventually bounce back. Okay, so let's put this all side by side. It's pretty amazing, right? When you look at our 3 pillars, the trader and the investor are like night and day. You've got short-term versus long-term, you've got frequent chart watching versus infrequent business research, and you've got managing risk on every single trade versus trusting in the long-term health of the company. Totally different worlds.
So now that we have this super clear framework, let's go back to that first question I asked. Which one of these sounds more like you? Let's see, you might be a trader if you love the action. The idea of buying and selling, being in the mix really excites you. You're making your moves based on where you think the price is headed tomorrow or next week. And honestly, you don't really care what the company makes or sells as long as the stock price is moving.
Now, on the flip side, you're probably an investor if you find a company you truly believe in for the long run. If the thought of all that fast-paced buying and selling makes you kind of nervous, and you see the stock market as a tool to patiently build wealth over your lifetime, then yeah, that's the investor mindset right there.
Okay, so by now you're probably leaning one way or the other. But what if I told you it doesn't have to be a black and white choice? What if this whole trader versus investor thing isn't the final answer?
Because here's the thing, for a lot of people, the best answer might just be yes and yes. It's absolutely possible to do both. You could have the bulk of your money in a core portfolio of long-term investments, this slow and steady stuff, and then have a smaller, separate pile of cash that you use for more active trading. You can get the best of both worlds.
Look, at the end of the day, there's no single correct answer here. It's all about what's right for you, for your goals, and for your personality. But now you know the difference. You've got the framework. So the real question is, how are you going to build your portfolio?